Commercial real estate services firm CBRE expecting 2025 to be a big year for the industry, saying while retail and data centers have been good, supported by longer-term growth trends, all the other sectors will see the start of a new cycle. Firm says while economic growth will support more household formation, the high cost of homeownership will still drive multifamily vacancies down. Good news for my next guest. His company just opened 3 multifamily developments this year in Miami, Orlando, and Atlanta, and is set to open one in Brooklyn next year. Here to discuss his 2025 predictions is Kevin Maloney. He's the CEO of PMG. Kevin, it's great to see you. Welcome back.
Thank you. Thanks for having me.
Just tell us kind of what you expect off the cuff going into next year.
Well, we think, listen, multifamily's been a little down. Rates are up, costs were up. A lot of multifamily is oversupplied in the marketplace currently. But on the other side of the coin, that brings great opportunity to buy, to lend into those programs. But for us, we're going to probably suffer the same consequences of a lot of the other builders and developers have suffered around the country is multifamily is oversupplied and needs to be absorbed. So I think the multi-business for the next year or so is going to be relatively soft.
Right. And while I don't want to cheer for you to struggle from an inflation point of view, I'm thrilled. I want to throw a party and say, great, rents are moderating, and that's going to bring inflation down and maybe the Fed can react. And it's been the biggest area where things have been sticky, right?
It absolutely has. And you're 100% spot on. So hopefully, listen, we've had three reductions in rates this year, probably about 120 bips. It really hasn't affected exit cap rates yet. On the leasing side, on the income side, we're seeing as much as 3-month concessions. So there's no question that there's going to be a downturn in the multifamily business. But again, smart buyers today, are going to buy Class A multi relatively inexpensive. They're going to sit and watch supply continue to dwindle, and you're going to see some shifting in rents again, and hopefully with some action by the Fed over the next 2 to 3 years, you're going to have a really winning formula.
Yeah, it could be a win for everybody. You see the most opportunity right now in South Florida, also Florida's West Coast, Florida, in Denver and in Nashville. Some of these markets people were concerned about a little bit of frothiness in years past. What do you see?
No, there still is. Nashville clearly is oversupplied right now, but Nashville also has great economics in terms of employment growth. A lot of companies, they're a tax-advantaged state, and Nashville is the center of that state. So we think on the long term, Nashville is a great bet. In Denver, we really are not going to be building and starting into the multi that we have sites approved for, but we are building luxury condominium in Denver, which is a new thing for us, and that's doing quite well for us. Atlanta also is a bit oversupplied, a great market to be buying in currently for a long-term play, but looking at it from a 12-month point of view, it's going to be soft.
By the way, how do you define luxury? When is it a rent threshold, an amenities type of thing?
It's all of those things. So it's really amenity driven. It's apartment layout driven. It's packages within the apartments, and that really drives rents. I mean, for us, we are always looking for the top of the market, the highest rents in the marketplace. We have to over amenitize the buildings. We have to deliver product that's far and above what would be considered typical Class A apartment.
Yeah, and where else do you think you are going to be able to capture the highest rents in the marketplace in the next couple of years?
Well, Miami is still a pretty hot market. We're about to launch, and which I think is one of the few multifamilies to get out of the ground this year, honestly, nationwide.
Wow.
We're about to launch a 550-unit rental on Brickell in downtown Miami. That market is still relatively robust and strong. So we're bullish there. And again, we're looking for opportunities on the buy side over the next year because we think, that we're going to try and take advantage of the softness.
Sure, take advantage of those distress. And are the banks a willing partner in that, or is this private credit? How is it funded?
It's mostly private credit from our point of view. The banks are, unless you've eroded value all the way down through into the debt, the banks really wouldn't be involved. It would be a purchase and a refinance, or be an investment into the vehicle with some sort of hope note for the current developer. All that, those strategies are being laid out currently in the marketplace.